All right, welcome everyone. I'm your host, and today we're decoding a document that is literally sending shockwaves through the entire wealth management industry. We're looking at China's highly anticipated tax regulations regarding offshore trusts, commonly known as Announcement 21. This single document is fundamentally reshaping how wealth is going to be managed across borders starting in 2026. So, let's just jump right into this explainer and answer the absolute biggest question on every wealth manager's mind right now. Are offshore trust assets still a tax-free vault? For years, navigating offshore assets felt a bit like operating in the Wild West, a lot of gray areas. But with these new regulations, the landscape is becoming crystal clear and honestly a lot more strict. We've got a lot of ground to cover, so here's our roadmap. Number 1, what are offshore trusts? Number 2, tax on funding the trust. Number 3, taxes during the trust's life. Number 4, termination and status changes. Number 5, closing the tax loopholes. And finally, number 6, important dates and deadlines. We're going to follow the entire life cycle of a trust to see exactly how these dense new rules apply.
All right, starting us off with Section 1, what are offshore trusts? Defining the target.
The crucial point here is that the authorities are looking directly at the substance of the arrangement, not just whatever name is slapped on the paperwork. An offshore trust is defined as any trust or similar legal arrangement established under foreign law that holds and manages assets. Basically, if your structure acts like a trust and manages wealth like a trust, even if you call it a foundation or a special purpose vehicle, it's going to be treated as an offshore trust. They are looking right through the labels.
But before you panic, there are exemptions. Standard, regulated financial products from banks or insurance companies that are sold to the general public, those are safely excluded. If you're just buying an off-the-shelf mutual fund, a standard insurance policy, or a bank wealth product from a heavily regulated entity facing non-specific clients, you're fine. The tax man isn't coming for your standard retail mutual funds. Those are specifically carved out from these harsh new rules. Let's move on to Section 2, tax on funding the trust. The toll to put things in. This is step 1 in our trust lifecycle, funding it. You've set up your structure, and now it's time to actually put your wealth inside the vault. And here's the kicker. Simply transferring those assets into the trust is a taxable event. Doing so forces the cost basis of the assets to step up to current market value. This is huge. It means you can't just quietly slide heavily appreciated stocks or real estate into an offshore trust anymore. The government literally treats the transfer itself as if you sold the assets. You'll be taxed on property transfer income, which they calculate by taking the current market value and subtracting your original cost plus reasonable fees. Now, the rules treat residents and non-residents very differently here. If you're a resident, you're taxed on any global asset you put in. But if you're a non-resident, the net only catches domestic Chinese assets you transfer. However, you have to be incredibly careful with commingling. If a non-resident and a resident both contribute to the exact same structure, the entire trust gets permanently tainted. It instantly falls under the much stricter resident rules, so keep those assets separated for sure. Next up is Section 3, taxes during the trust's life, growing inside the vault. Okay, so the trust is funded. We're now in the maintenance phase. Your assets are locked in the vault, hopefully generating some nice dividends and capital gains. But how does the tax man treat this ongoing growth? Well, look at how rigidly these regulations separate property transfer income from interest and dividends. You are explicitly forbidden from offsetting one against the other. Let's say you took a loss on a property transfer? Too bad, you cannot carry it forward. Want to deduct your hefty trust management or legal fees from your dividend income? Absolutely not. It's an incredibly tight net designed to maximize taxable income without giving you much wiggle room for deductions. And this brings us to a really crucial concept. Phantom income. The regulation states, in black and white, that residents are taxed annually on these trust earnings regardless of whether the money actually leaves the trust. You might not see a single penny hit your personal bank account, but if the trust generated the earnings, you, the resident, are legally on the hook to declare and pay taxes on it every single year. Moving right along to Section 4, termination and status changes, the fee to take things out. Eventually, every trust's life cycle comes to an end, or the keys are handed over to someone else. So what's the final exit toll when the vault is emptied? Essentially, life events trigger taxes. It's that simple. Changing your residency or passing away triggers an immediate exit tax, or what they call a deemed liquidation, locking in taxes based on the market value on that exact day. If you're a resident and emigrate to become a non-resident, boom, exit tax on market value. If a resident passes away and leaves the trust to a non-resident, it's treated as if the entire trust was liquidated the day they died. Though, if it's passed down to another resident, it just smoothly continues under normal resident rules.
All right, Section 5, closing the tax loopholes. Anti-avoidance measures. Regulators know exactly how people try to hide wealth, so they're specifically targeting holding companies that don't actually do anything. If an offshore entity controlled by your trust gets 50% or more of its profit from passive income, like dividends, rent, royalties, it gets captured under these new rules. They will absolutely pierce that corporate veil and apply the trust tax rules directly to the underlying assets.
And what exactly constitutes control of these offshore entities? Just 25%. Holding 25% or more of the equity or voting rights is enough. Plus, the authorities calculate this by multiplying ownership across multiple layers. If there's a complex chain of shell companies, they will literally trace the ownership all the way down to the bottom of the ocean to ensure that 25% threshold is accurately measured. Simply put, there is nowhere to hide.
You also cannot treat the trust like a personal piggy bank anymore. Paying for personal expenses or giving yourself an interest-free loan, those are now officially deemed taxable distributions. If your offshore trust buys a luxury villa and lets you live in it for free, the tax authorities are going to calculate the market value of that free rent and tax you as if the trust had handed you that cash directly. The tax man is definitely watching.
Finally, let's wrap up with Section 6, important dates and deadlines, the compliance timeline.
The deadlines here are tricky. If you are a resident just declaring standard annual earnings, you've got a pretty comfortable window next spring, between March and June. But if a life event happens, someone dies, residency status changes, or a non-resident funds the trust, the clock ticks incredibly fast. You generally have to file within just 15 days of the following month. And this right here is the absolute most critical takeaway from today's explainer. The government is offering a 90-day grace period from the July 24, 2026 implementation date to pay uncollected taxes from 2023 through 2025 without late fees. Yes, you heard that right. The rules are retroactive back to January 1, 2023. But if you step up, declare those past earnings, and get compliant within those 90 days, they waive all late payment penalties. Once that window shuts, strict enforcement and heavy penalties kick in.
This leaves wealth managers with a very narrow window to review their offshore structures. The entire landscape has fundamentally shifted, and the era of hiding behind undeclared offshore assets, it's officially over. So the clock is quite literally ticking. The real question you have to ask yourself is, when the tax man comes knocking in 2026, will your vault be ready for inspection? Thanks so much for joining me on this explainer, and I'll catch you in the next one.